Are you expecting 75 for this year or 100? And does it actually matter in how you're going to allocate in equities?
Well, I think it matters because there's a huge amount of money sitting in money markets. It's been the fastest growing asset the last year has been money market funds, and understandable because rates are very high. So it matters because the speed with which they cut rates is going to cause money markets to become less and less attractive. And could that be actually, the gasoline that accelerates the market, as rates drop, say, below 4% early next year? I think that could be a big driver. So, yeah, the speed with which they cut is going to, be directly linked to how fast money comes out of money markets.
Why are we so convinced that that's actually going to happen? Like, why can't the money just stay there?
Well, because I think just two reasons. Number one is, unfortunately, investors look backwards to frame their viewpoints on investing. And so 5% in the money market looks attractive when the year 2022 of a bear market is still in the rearview mirror. But now we've got 2023, which was a good year for equities, and also now 2024, good year for equities. And suddenly you have a combination of returns for equities is far better than money market, and the yields on the money market's going to go down. So unfortunately, Alex, it's human nature to chase into better returning, especially when rates aren't as attractive. So I think that's what, that's normal, and that's probably what will happen at some point late this year, early next.
Yeah, I mean, at some point we're definitely going to get there, particularly if rates do come down as much as the market thinks they will be. Before we get there, though, Andrew, there is a big question here as to who is willing to embrace the equity market right now at current valuations, given what we know about the economy, given what we know out of this past earnings season.
Yeah, I think that's fair. And a couple things. Number one is, I think the S&P has fully reflected the Fed beginning to cut rates. But I think that's why you're seeing a rotation into other areas of the market, like the S&P equal weighted, like the interest rate sensitive stocks, utilities, REITs are doing better, small caps. And with the dollar weakened, I wouldn't be surprised if international markets do better. So I think the large caps have priced in the rate cuts, but I'm not sure other parts of the equity market have as much.
Are we looking at that proverbial soft landing that I know we had all kind of embraced a couple of years ago when this rate cycle started? Is that still a realistic outcome?
Well, I think it is, but it worries me, Romaine, that so many people now expect it. And we've just had this V rally, we went 5670 to 5100 back to 5600 awfully quickly. And it's this expectation of everything's, the soft landing and lower inflation. So could that thesis be challenged in September? I think it's very possible. What worries me is the number one buyer of stocks, and I don't think this gets enough interest, the number one buyer of stocks is corporate buybacks. Mm-hmm. They were big, very aggressive buyers when the market sold off in August, but the window closes because it's coming up to third quarter earnings in the second half of September for over 50% of the corporate buybacks. So they're not going to be buying back stock at a time when seasonally the second half of September is a very bad time of the year, right when the Fed begins to cut rates. I just worry that a lot of good news to your question is priced in short term, and could we have a hiccup that cause, who knows, maybe inflation print is a little higher, or the economic data comes in a little weaker. That's the type of thing that could cause, a pullback.
A hiccup, is it going to be like what we saw in the beginning of August, that kind of hiccup, or something more severe, or just a bump?
Well, I don't, I think we're going to have a fourth quarter rally. I expect the market will end the year closer to 6,000 because I don't see the corporate earnings story as weak. And that's kept me very grounded the last couple of years in avoiding kind of all the worries of the bear market has been this continuation of earnings estimate revisions, especially for next year going up. And that's what's so important, because on December 31st of this year, we're going to be pricing off 2025 earnings estimates. And right now, the bottoms up is $279 or so. So that's what analysts have been guided to by companies, is $279 a share. But top down, Wall Street is much lower in the 260 range. So I think just like last year, you're going to see a lot of strategists be forced to raise their earnings outlooks for next year. And so I do think fourth quarter will be strong, but could we retest that 5,100? I would be surprised. But I do think there is that commonality, is usually when you have an earthquake, there are tremors after, and boy, we haven't seen one yet.